Well, hello again, investing fans, and welcome to our latest video report. Dion Zukiwsky, branch manager and portfolio manager here again with you. And we've seen a lot of change since our last update. Market direction has been changing both ways. The economy's changing, the weather's changing, even the Edmonton Oilers have had a coaching change. The list goes on. For our report today, we're going to look at investment direction and what's happening next, what changes are coming up, and how it may affect your plans. Also, with interest rates being where they are, we've been getting a lot of questions around fixed income ideas, such as bonds and GICs. And we'll bring the team's own Bond Jewell in to look at the pros and cons of each of those. Well, after a decent first half of the year, markets saw some swift corrections in September and October. The good news is that November has been noticeably better, and we're hopeful for a positive finish to the calendar year. It appears that interest rate hikes are at a plateau at this point, with inflation getting more under control, actually going lower both in Canada and the United States. Despite these interest rates, consumer spending has remained resilient. And to avoid a major recession, this needs to continue, although it does appear to be slowing as savings accounts are slowly being depleted. We looked at this in more detail with the Scotiabank Spending Tracker. That follows data based on debit card use and credit card use across Canada. And we'll look at more of it here. In reviewing this chart, we see spending remains strong this year, which in 2023 is the green bars, especially in areas of movies and entertainment, along with travel. However, it is moderating in areas such as clothing and other retail spending such as home and hardware. Definitely interesting to see where trends go from here. The other positive we're seeing is more in line with market-related items and corporate earnings. At this current time of recording, over 82% of the United States' reported companies have come back with higher than expected earnings per share numbers. This will actually be the first quarter since about a year ago that we've seen this positive momentum. Here's how it looks over the last number of quarters. Another positive change, and if interest rates continue to stay put, and the possibility they may even come down next year, should help boost corporate earnings further, as evidenced in the graph by the right-hand bars. We see that the last part of 2022 and the first part of this year has been negative, but estimates are quite optimistic going forward, which will definitely help share prices. Now, these are the positive changes we're seeing. What about the other ones, you ask? Well, the two that stick out to us are overall indebtedness, both on the personal and corporate side, along with the labor market. So with interest rates zooming in the last couple years, it's a potential cause for concern. And the simple explanation is that if outstanding loans have floating rates or are needing to be renewed, then their interest carrying costs are significantly higher. On a personal level, this could mean higher mortgage rates or other loan payments, meaning less disposable income to spend in other areas. On a corporate level, it means more cash flow is needed to service debt and possible hold on investing in capital projects until these rates stabilize. The other concern is the labor market. As companies look to keep costs under control, many times having less workers is one option for them. Combined with slowing wage increases, this could snowball into a larger economic issue. Put it all together, and our Scotia strategists believe that the risk of a major recession has come down, but isn't totally off the table yet. It's very important to realize that if there is a technical recession, it likely will be quite shallow, and history is on our side here. In fact, since the 1950s, we've only been in economic recession about 14% of the time. So strategy-wise as investors, what should we do from here? Well, since earlier this fall, we've been positioning models more conservatively, reducing market exposure, and adding high-yielding fixed income, such as bonds. Our plan is to monitor very closely market conditions until there's more stability, and then we'll be adding back into the growth side of things. For now, we'll stick to our core investing principles of owning high-quality investments across different asset classes, all in an effort to keep risk as low as possible. This includes owning cash savings, blue chip shares, alternative ideas like real estate, and fixed income like bonds and even GICs. And in fact, we've been getting a lot of questions lately on what is the best defensive option to look at in accounts these days. Is it bonds? Is it GICs? And with more on this topic, we'll bring the team's own Bond Jewell to talk more about this.
Welcome to our Did You Know segment. Today we're going to be talking about GICs and bonds. GICs and bonds are very similar investments. Both are loans to a financial entity in which you receive interest and then your principal repayment at a future date. Both are considered conservative income generating investments. The silver lining to the interest rates going higher over the last few years is that bonds and GICs are now offering better yields, which we then get lots of questions from our clients about whether it's better to invest in GICs or stick with bonds. Now, for time horizons of around a year, a GIC is perfectly fine. We do caution about using GICs for longer time horizons as an alternative to bonds. Let's take a look at some of the characteristics here. Capital appreciation. GICs never decline in value, but they do not offer any capital appreciation. Bonds, on the other hand, provide the potential for capital appreciation, particularly during downturns or when interest rates decrease. Liquidity. Unless cashable, most GICs are not redeemable without incurring a penalty. Bonds, on the other hand, boast superior liquidity versus GICs as they are easily traded. Tax efficiency. GICs exclusively pay interest income, which is taxed at your highest marginal rate. Bonds pay interest and offer capital appreciation potential, which can be more tax efficient. We are always happy to answer any questions, and please feel free to reach out to discuss your personal circumstance. Happy holidays and a prosperous new year from your team at the Zukiwsky Group. Thanks for watching.